2025 projections. So we get through this year, a couple things. Melt up, seasonality. I don't really expect a lot to derail the market. But what did I say? The couple things that I would be watching that could potentially derail this great rally we've seen would be inflation ticks up higher tomorrow and Thursday with CPI, PPI combo, and PCE at the end of the month. We get into December, if I'm not mistaken, we're going to see the CPI and PPI before we have the Fed decision on the 18th in December. So if the Fed does not cut rates in December, that could be a red flag for the market to maybe end on a sour note. We might have a pullback. We might have some aggressive profit taking. We might have something where the market, gets up to highs and then dips a little bit. And then, of course, we're curious, like, does that momentum carry into to January 2025? Is that just a little profit taking and then the market rips like it's, just picking up where it left off in January? We don't know. But I could see that being a bit of a derailment to the end of the year. Going into 2025, here's what I'm looking to do. Any ownership that I have better be a strong fundamental stock. Okay. I am not looking to speculate on stocks that have been down. I had this conversation yesterday. Somebody asked me to look at Estee Lauder. The ticker's EL. The stock is down over 80%. Okay. And it looks cheap. Okay. But all I did is look at the snowflake analysis, looked at the fundamentals, and it's still trading at like 100 and something price to earnings. Which is really, really high. And it's down 80+%. It's like, if I look at any stock out there that's down 60, 70, 80, 90%, some traders look at that and they think, oh, this screams value. I look at that and I'm like, this thing is a dumpster fire. If we have had all-time high after all-time high after all-time high, and I know the market breadth has been, this big story this year because we had so little concentration, all led by Mag 7, all with the potential, carry on of AI and semiconductors. But between one sector, semiconductors, right, or one component of stocks into the Mag 7 with large cap tech, the earnings in the S&P, the gains in the S&P have pretty much been contributed to that alone. Okay, and then it did broaden out a little bit because we saw utilities do well, we saw financials do well, right? The Russell's doing really well because we had a big jump in financials. So banks are small caps. So your financial stocks, they've ripped the last week since the election, and that's why the Russell had such a big run to the upside. But flight to quality is this. If I look at a company's fundamentals, I want to see that they have cash and they don't have a lot of debt. They have expected growth for the year of, the next 3 years, the next 5 years, the next 10 years. I want to see earnings per shares. I want to see trends that are positive. Okay. I'm not interested in owning something or wanting to own something because it's cheap and it's like it's oversold. It looks like a good technical trade. It's not good enough. Okay. Now that being said, if we're back down to like 2020 lows, or we're back down to 2008, 2009 lows, I'd be interested in throwing an options trade at it because maybe it is a low value play, right? It's a value play where maybe there's some upside potential and maybe it turns into an income play, but nothing I would say I'm going to bet heavy on. Okay. So growth, cash, quality fundamentals, dividends is an extra plus. I mean, dividends typically depends on this one. I don't like, the crazy high dividends with a lot of volatility in the price. I mean, I want to see like a low beta, low correlation, I'd say adequate dividend. I'm not looking for like, 8 to 10% dividends. But if I see something that's steady at like 4 to 5, 6%, that's consistent, has a solid dividend track record, that has good quality fundamentals, then sure. We'll talk about the price and maybe there's an opportunity to buy a little bit cheaper. That's if I want to own anything. Otherwise, I might not own a lot of anything. If anything I want to own, I always like to own the SPY, the Qs, or related ETFs like RSP and QQQE, because those are cheaper. Those are equal weighted. You can trade options on those as well, but they're way cheaper. I mean, the QQQ is over $500 right now. The QQQE is like $100. Big difference. Now granted, it's not as liquid. The option premiums aren't as good, but for essentially expressing the same thing, I'm going to stick to more of the equal weighted just because it's cheaper. That's kind of buy and hold. And then, I'll position the SPY and the Qs when I want to, but I do a lot of like income trading on those indexes anyway. But flight to quality, that's my thing, is I'm not planning on owning a bunch of new stuff in 2025. I will keep lots of cash at the ready. One thing I think we can all learn from Buffett here the last like 3 to 6 months is that he has been a net seller of stocks, right? So whatever you want to say that is or what that equals, is Buffett bearish? Not necessarily, right? I mean, what we are seeing is that there's not a lot of buyers that are coming in at these all-time highs. Now, there was a quick jump in, like this injection we saw during the election, like clearly something mattered. And there was some FOMO and there was some participation, and it looks like the coast is clear. We're going to have all these cuts and all this stuff's going to be great for growth. Well, it's instant gratification because we got it. I mean, we had one of the biggest moves and the biggest weeks that we've seen in years, the day after the election and the week of the election, right? If you look at every candle on the week, they were massive candles with big moves, plus huge gaps. So Buffett has been a net seller of stocks. He's sitting on a ton of cash. I think I had a screenshot here, but they have put in, are they over like 300 billion in cash right now? I think I have a screenshot. Let me find out.
Where are we going again?
I thought you plugged it into the GPS.
Oh my gosh, what is that? What's happening?
Relax, it was a pulver alert.
A pulver alert?
Yeah, you know, Chris Pulver. He teamed up with A1 Trading, and now you can see all of his trades, and it's all through Discord, so I can easily check them anytime on my phone or desktop. Plus, you can get notifications when new messages are sent.
Frank, that's really cool that you can see his signals, but like, why are you doing that when we're space traveling?
Because I'm bored and we have light years till our next destination.
Another trade already?
Actually, have no idea what that is. We might be in trouble.
Pulver alerts are now available on the A1 Trading website, and for a limited time, you can get them 40% off for the Black Friday sale event. Don't miss out on getting Pulver alerts for the best price anywhere in the galaxy. We're dropping the link to get Pulver alerts 40% off right now in the chat and the description down below.
Nick, Frank, you watching gold?
Roger that, Pulver. We got the alert.
I'm gonna throw a number out there. I could be wrong, but I'm pretty sure that's something to the tune of like 350 to 375 billion dollars of cash that they have right now. Is that right, or is that like crazy off? Either way, they're raising cash. Okay. Now, does that mean that they're bearish? Not really. If the market wants to melt up, their positions are fine. But what that does mean to me, and what that tells to me, is if we see better opportunities at discounts, if we see quality companies at discounts, that's what that cash is for. It's ready to go shopping, you know? And to what degree, I don't know. But if we have an index correction of 5 to 10%, there's probably gonna be some buying opportunities. If we have an index correction of 15 to 20%, there's absolutely gonna be buying opportunities. Anything deeper than that, it's going to be ugly, right? If anybody thinks about this and it's like, well, I'd love to get a 20% correction. Well, the way it's going to feel is going to be like crap. It's going to feel like crap. That the market's going to go essentially bear market, 15 to 20+% sell-offs. Stocks are going to be down 1.5 to 2 times that, 3 times that. Like, it's going to get really ugly out there. So as much as you want discounts, it never feels good with how they happen. And that's why they're so slippery and so tricky, because the saying is this, bulls climb stairs and bears jump out of windows. And it does get really nasty. But at the same time, if you just have the cash, it's not like you have to go all in. If Buffett's got $300 billion on the sidelines, it's not like the first sign of a dip, he's putting in $300 billion in cash. It will be allocated, dollar cost averaging. They'll probably sell puts and they'll do stuff at discounts, and they'll do what they always do. But it's just going to kind of wait out for these higher valuations. We're at some of the highest valuations that we've seen in history. Last time we've been at these levels, we were up to the 2020 highs before we crashed. We were up to the 2021 highs before we had the bear market in 2022. And we were up to the same highs we saw back in the late 90s before the dot-com bubble, as well as 2007 before we had the great financial crisis. That's how high we are with some of these valuations. Okay? So eventually, it's going to matter. Chat GPT says 325 billion. Okay, I wasn't that far off then. All right. Next, U.S. inflation. Inflation persists, Fed soft landing fails or proves difficult. The Fed's already gotten away with this at 50 all-time highs. The Fed has navigated a great soft landing. Now, did they crush things? Sure. It was a little ugly back in 2022, but thankfully the Mag 7 helped us out of it. And then the Mag 7 was followed up by AI, then followed up by a little bit of the broader market rallying and breadth that came in through 2024, right? Stagflation. Higher growing costs, or higher borrowing costs and growth woes. This is what I come back to, the yields. I come back to this. If you have higher borrowing costs, it is going to choke out growth. If we have persistent inflation and we're choking off growth, That, ladies and gentlemen, is stagflation, right? Even if it's a little stagflation, it's still stagflation, right? I don't know if we're going to have a 1970s, 1980s, inflation battle like we did. I don't know if we're going to have that again. You'd hope that we don't, because I don't think that we're equipped for it. If we have a second wave of inflation that is worse than what we just saw at the peak at 9%, if we get something worse than that, I mean, I would expect to see like a 40 to 50% correction in the stock market, because we would have a second wave of inflation at debt that has been incredibly higher. I pulled a crazy stat this week, and we talked about it in one of the live sessions. Since the Reagan administration in the 80s, the US has grown at about 600% GDP. Okay? But we have added debt to the tune of 3,600% GDP. So we have 6x leveraged our GDP in order to grow to be where we are today. So we have only grown because of our need for debt. And it's scary because it's unsustainable, But I also know that it's not just the US, it's not just Europe, it's not just Japan, it's not just China, it's everybody. Everybody's in it. And it sucks, because at some point that doomsday debt clock will have some victims and it will have some reality checks, but nobody knows when. And that proverbial can get kicked down the road forever. And it's probably the goal is like, we'll never have to deal with it. We'll just keep kicking it down the road. But we are borrowing from the future to pay for today. Absolutely. And we're doing it to like a reckless degree. It's really ridiculous. But all that is this: inflation persists. It doesn't have to necessarily get higher, but if it just persists and it sticks, it still sucks. If borrowing costs stay sticky or go higher, that's not good. And that will drag on growth. All right. So if we are, think of this, who knows, like the old, I don't know the game that it was, I don't know the specific name, but Price is Right. You had like the yodeling little mountain climber that went up the little mountain, right? You have to name the prices until he falls off the cliff. That's where I think we're going. Now that cliff is, I don't know what degree, but let's say it's a nasty bear market that's ahead. I wish I had the stats right here, but something to the tune of every like 2 years, we typically see like a 10 to 20% correction. Every 4 years, we see a 15 to 20% correction. We're kind of in that same window again. We had our big correction in 2022. All we had this year was a little bit of a hiccup in April because we thought inflation is going to be sticky and the Fed didn't want to cut rates. So the market dipped like 5 and 6%. We had the deleveraging of the Japanese yen very quickly unraveling through July and August, and that ended up being a 10 to 15% correction. And now here we are at all-time highs. Like, it doesn't even matter. I mean, they were such short-lived corrections that nothing's been sustained. Nothing's been rolled over and stuck, right? There's been no 10% didn't go 15 or 20%, So if we roll over 5 or 10%, what happens to the next dead cat bounce where we roll over 10%, we go up, and then we roll down another 10 or 15%? We haven't seen that in 2 years, right? The last time we saw high, low, lower, high, lower, low was 2022. So if that happens for the first time, there might be more to that, right? So growth could struggle in the next 12 months if inflation does not stay or get softer and growth struggles. It's that simple. And if borrowing costs are higher, it is going to make growth more difficult, right? This is why I say this next one. Something breaks. Valuations are as high as they've been since we had previous bear markets, back up to the 2020, 2021 highs before we had a bear market in 2022. I don't think they're as high as what we saw back in 2000. Maybe they are. I'd have to look at like the price to earnings, historical price to earnings, historical price to sales, price to peak sales. All these levels are up there where we're sitting at like a 23 price to earnings, or I think it's price to earnings is 23. Historical average is 17. If we stretch up towards 25, 26, oftentimes we do have corrections. So it means there's still some room to run, but valuations get, too high or all-time highs. It's not every company. It's still a thinner bit of the herd. Okay, market or economy running too hot. Well, if we have a blow off top, I'm definitely going to get more protective on those tops, and enjoy the melt up, but just be prepared for some protection. Inflation's not under control. If inflation ends up breaking or the 10-year yield goes higher and it breaks, something's going to roll over. Price is going to lead the way. The Fed pivots, has to react to something, so they either they pause from cutting and they react to something that breaks, like a failed bond auction, or they react to something aggressively, maybe Trump does do something to disrupt the Fed. I saw this last week, like Elon Musk, Trump making comments about like doing away with the Fed, or okay, if that's a big deal. We're taking away, like, it is our printing press. You're going to take that away and say that capitalism can run it better. Maybe it can, but it's going to be after a terrible, terrible shakeout, right? And the last thing is we are so entrenched in US, and everything's got to happen here in the US. Look, other stuff around the world could also leak into the US. If the entire Eurozone goes into a deep, deep recession, it could leak into the US because we're partners and allies, right? And they're also part of the same financial market we are in the globe. Okay. If something happens where China, like even this stimulus and this round of stimulus and these animal spirits, if they just fall flat, China's world number 2. It's not like they're going to go down and say like, well, we tried, stimulus didn't work. Okay, we'll come back and fight another day. They are the one biggest power that is trying to become world number 1. They're not going away. They have absolute authority and absolute power to do whatever they want for a longer duration. The US politically operates in 2 and 4 year cycles. China operates under absolute power. They can do whatever they want. So they play the long game, all right? So my point is, it doesn't have to be something that has to break in the US. The US could actually be steady and resilient and stable, and there's lots of investment opportunities and things look good and companies look great. But if something breaks and eventually that global liquidity starts to dry up, that money supply starts to go sideways or stagnant, starts to decrease, okay, debt spirals elsewhere, and then it leaks into the US, like all these things could be what if, and what's going to lead the way? Price. So I just want us to be aware that stuff can happen. But as a contrarian, here's what happens. Did anybody see COVID being the reason that the market was going to break in 2020? No. Okay. I was bearish going into 2020 because of what happened through 2018 and 2019. 2017 had a 12 for 12 higher highs in the S&P. That's never happened in the history of the stock market. 2018 January was a big vol event, a big crash. We melted up with a Fed put immediately through 2018 into 2019. 2019 into 2020 was more of a melt up. I was bearish just on the technicals. COVID was the bow and the excuse that the market latched onto and said, this is why we're going short. So the market did, and what do? We bought our way out of it. Okay, and then you work off that momentum for almost 2 years, like April 2020 into basically November 2021. This market was in one of the greatest melt-ups ever on just sheer liquidity, like $4, $5, $6 trillion going into these markets, and that still carried a lot of momentum. And then we started to top out because the Fed actually was starting to be vocal on raising rates. And when did they finally start to raise rates? 2022. So it was all starting to tip over, and then we peaked out in the NASDAQ in November 2021, and we rolled over hard in 2022, and then we peaked in January 2022 for the SPY, or the S&P, and then we rolled over hard in 2022, right? So something will be there, price will ultimately tell us, when to be watchful. Now, when I go to the charts here, I know this hour's flown by already. When we go to the charts, something as simple as a 50 period, a 100 period, a 200 period moving average on a daily or weekly time frame. If that's all you watch, you'll be fine. Just don't be super greedy. Have some cash at the ready. But if we're staying like really well resilient within, like, we've got room to find that 200 moving average, we can find it over and over again and still offer a buying opportunity. The big crack is when the 50 period crosses that 200. That's the death cross. If price is making lower highs and lower lows through that death cross, then we probably have some momentum to the downside, right? So technically it can be really easy. But the hard part is everyone wants to call that top and everyone wants to call that bottom, and they're always wrong. It's like the most difficult thing to do. Okay? All right, back into the gold, silver, Bitcoin here for the slide. Bull markets remain healthy. I like the idea of also diversifying away from the dollar. Even though the dollar's been ripping hard, I still like the technicals where the dollar's going to sell off at some point. Black Swan event, this is stuff we don't know. I'm just throwing it out there for a couple things to be aware of. If China makes a move in Taiwan, that's certainly be a problem. We literally enter a World War III environment. We have some type of cyber warfare. Call that World War III. I have no idea. A debt crisis. It doesn't have to be the U.S., but it could be global. We could have a global fiscal crisis. We could have a global debt crisis. Maybe it starts in Europe. goes into the US. Maybe it starts in Canada. Maybe it starts in, I mean, who knows? Maybe it starts somewhere and that ripple spreads through the whole pond and eventually it poisons everything. You never know. But a fiscal crisis, a debt crisis could be a thing. Debt servicing, higher borrowing costs, that's a big deal. The 10-year and the 3-month disinverting hasn't happened yet. But I looked at that chart, I think it was yesterday. I just put that vertical line, right after we had the inversion of the 10-year and the 3-month. And I looked at, okay, so we disinverted here. How much longer till we have the recession? It's usually a matter of months. I mean, the average is around like 12 months after the disinversion of the 10-year, the 3-month. But it's been as little as 1 or 2 months. It's been as many as like 30 months. So we don't know, but it is an undefeated indicator. And I believe that in probably a 1 or 2 year window from this disinversion, whenever it happens, within about a 2 year window, we're probably going to have some type of correction, some type of bear market that we have to deal with. Okay? So just be ready for it. Now, is that a black swan event or any of these black swan events? Not really. A black swan event is something you don't see coming. And that is the next thing. It's like, it could be just a giant question mark and like, oh, that's what happened. Nobody saw that coming. And that's also why we haven't had a recession, because everyone is talking about how we have to have a recession. It's gonna happen. It's sure. But what exactly is the thing that breaks it? Maybe it's not on this list. Maybe it's so obscure. Maybe it hasn't even happened yet. Who knows? But that's why it's not all eggs in the basket. That's why there's a little bit of diversification. That's why it's important just to make sure that we have, defined risk and we're taking care of our equity, right?
Did you know we do a live trading show Monday through Friday with guests from all over the world? To get notified when we go live, click the bell button next to the subscribe button or check in at 9:30 a.m. Eastern Time. We have helpful, free content in the description below and on our website, a1trading.com. Thanks for watching today's video, and we'll see you tomorrow.